Good morning. It is Friday, February the 20th. Here's what's on the agenda. Oil at 6-month highs as Iran simmers. Private credit cracks, and it is a big day today in the US.
Absolutely, Tom. Let's take a look at these markets. Brent crude up by another 0.5%. We're trading at 72.02. What is interesting is that Brent is now moving away from WTI. Dubai is moving away from Brent. The story coming out of the oil market is of simmering concern about what is happening, what could happen this weekend with Iran. Eurostoxx futures are actually higher this morning. We're up by around 0.5% going into a lot of data in the United States a little bit later. We've got plenty of earnings to factor in as well. But keep an eye on the dollar. Just getting a little bit of traction. 117.57. We are down on euro dollar. Pay attention to that. If the dollar starts to move a little higher, that's definitely a risk indicator as well. Plenty to discuss this morning. The countdown to the opening trade starts right now.
And we do have some work to do with Iran. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon.
President Trump also outlining a time frame when it comes to Iran. 10 to 15 days is what he has posited as a time frame to get a deal. There is not much evidence that Iran is moving to make a substantial deal within that time frame, but we'll see how that changes, Guy. This, as the military build-up continues, the reporting from the Wall Street Journal suggesting that President Trump and his team could be looking at a limited strike initially to put pressure on the regime in Iran. The pressure is certainly building.
I don't know anything about the geopolitics. Let's not go into the geopolitics. Let's talk about kind of what we are seeing in terms of how the market is positioning for this. The market clearly sees a risk. Oil prices are moving higher. That is a cause for concern. It is an inflationary story which the Fed is going to, and other central banks are going to have to pay attention to. Trump is putting enough kit into the Middle East that he could sustain the war for quite some time, and that maybe signals that this isn't going to be a kind of short one and done, similar story to what we saw with the last Iran strike. That is what the market is pricing in at the moment. If we were to see oil prices getting significantly more elevated from here, that has a really big impact on the inflationary story in the United States, which has been driven lower by gas prices of late. You take that out of the equation, you start to see a much stickier inflation story emerging in the States, one that potentially the Fed or it could change the Fed's outlook when it comes to the inflationary story. So I don't know. The geopolitics, Trump's timelines, I have no idea. Really hard to call. Last time they meant nothing. Will they mean something this time? All I know is there's a lot of kit there. You could see a big war. If you see a big war, you're going to see higher oil prices. Iran's got its back against the wall. It could hit oil infrastructure. That's the risk.
Iran produces about 3 million barrels per day. Most of that goes to China. So China's response to this, given the cut-off of oil from Venezuela, is going to be really interesting. It's the Strait of Hormuz. 25% of maritime oil travel goes through the Strait of Hormuz. Will it have to be redirected around the Cape of Good Hope? And what that means for costs and for time frames.
You have to get it. You can't. You have to get it out. Saudi can send some oil across and take it out through the Red Sea, but that generates a problem as well in terms of what's happening there with the Houthis. You've got to get oil through the choke points of the Straits of Hormuz. That's the risk. That impacts Saudi crude, that impacts Qatar gas, that impacts Kuwaiti oil, that impacts UAE to a certain extent. That's where the risk lies. That's why the risk premium is being built up. Brent is now trading over TI. Dubai's trading over Brent. That tells you that the market is indicating that it is concerned about what is happening here.
There are other concerns in the markets when it comes to private credit. And this was a big focus in the US yesterday then, Guy. Blue Owl Capital in the mist. So under pressure. And a number of other competitors as well, the likes of Blackstone and Apollo, all seeing their stocks dropping on the back of this story about capping withdrawals from one of their funds, and importantly, a fund that retail investors can get exposed to.
So there's a number of different angles on this. Firstly, yes, you saw Blue Owl stock down at 1.10%. I think it closed down circa 6%. So there was pressure on the stock of these kinds of companies. These are the companies that have been marketing their BCDs, business development funds, basically, to retail investors, like reasonably sophisticated retail investors, but still retail investors. And they saw a big redemption call late last year. They've therefore sold some assets to 4 funds, one of which is their own, in order to provide liquidity for ongoing returns of money. About a third of the fund will go back to investors. And then the cadence will basically be, they're going to kind of wind this thing up effectively, that they are going to return money to shareholders. There was a story yesterday about kind of gating these funds. They've pushed back on that quite hard. But the bigger picture here is two things. One of which is you've got this illiquidity sort of duration mismatch between short-term retail desire for money to come back quickly and these funds effectively being semi-liquid. So you've got that kind of issue, which is one that we've been talking about for a while. The other one is that you're getting this increasingly strong relationship between private credit funds and insurance businesses. And that two areas of the market that regulators really struggle to get a line of sight on in terms of where risk lies. And that's going to cause a lot of headaches at places like the Bank of England and the Fed and other central banks around the world.
And really interestingly, the private credit space, one of the big sells was we don't have the problems around mismatching. And now with that retail component, it seems it's becoming a challenge.
I never understood that, to be honest.
Well, I also wonder how it ties into the data centre funding story as well. We had original reporting originally that from Meta was tying up with Blue Owl Capital as one of its backers of a big infrastructure story in the US. So to what extent does this connect into the data centre story and funding around CapEx and AI as well? Something to watch. Interestingly, at the time when Bank of America comes out and says it's going to be committing $25 billion to private credit deals, so joining the likes of JP Morgan on that front.
But it just has that deeper, it's just bigger, and therefore relative in terms of the size of the funds, it's a completely different kind of order of magnitude. Let's talk about the data we're going to get out of the United States. We're going to get DEC data, December data on PCE a little bit later on out of the United States. We're going to get GDP data as well. People are watching the inflation story very, very carefully. CPI came in okay. One of the reasons why CPI came in okay a few days back was because of the gasoline component, which is now changing quite dramatically. So you're going to get PCE data a little bit later on today. Sort of tips auction yesterday that actually went really well in the States. It was a 30-year, and basically that's signalling we'd like some inflation protection. That's what the market is signalling by basically accessing that auction as strongly as it did. So the market's clearly worried about this inflation narrative.
So this is delayed PCE data for December. Core is, to your point, expected to come at 2.9%, so slightly higher than the previous month of 2.8%. To what extent are we getting inflation in the US anchored now closer to 3% than the 2% Fed target? Really interesting, I thought, and you kind of pushed back on this in the editorial meeting, but Stephen Myron, of course, who's taking that very dovish stance, saying that he is actually rethinking how far cuts can go in 2026, sounding moderately less dovish.
The guy's got to look at the data and just go, this is an economy that is very strong right now and clearly has an inflation issue, and the labour market looks like it's stable. Did you see claims yesterday? Claims were really strong yesterday. So he's obviously looking at the data. He's still calling for a lot of rate cuts. But the market's backing away from that rate cut idea. We've still got two price, but more and more people I'm listening to are telling me that it's going to be 0 to 1, maybe, in terms of the rate cut story this year. But rate hikes are now being discussed as well. And you just wonder whether the curve is going to flatten up like Australia has seen, as we start to see the central bank maybe turning potentially more hawkish. Are we heading back towards a 5% US 10-year? That's another conversation I'm beginning to hear a lot more about.
Briefly worth mentioning, the Supreme Court will be holding a decision today. That could be around tariffs. We do not have confirmation of that, but they are having that. They will be gathering and having a decision, the Supreme Court, today. And it's possible that tariffs are part of it. And that debate around tariffs and the impact on inflation is continuing to be pretty heated in the US amongst officials. We go back to the earnings story.
We've got a lot of corporate earnings still coming through. It's been a big week for it. We continue that today. Anglo's out with its numbers right now. Starting at sort of the key numbers in terms of what we are seeing. The full-year adjusted EBITDA coming through at 6.4. The estimates for 6.34. So pretty much in line with the estimates in terms of what we are seeing there. The key things, the two kind of key questions around what we are seeing with Anglo right now is what is happening with De Beers, which the business is trying to sell, which is the diamond business. The diamond business at the moment sucks. It's horrible. It's really difficult to sell diamonds, which I find amazing. Please don't tell my wife. Anglo American taking a pre-tax impairment charge of 2.3 on De Beers. It's trying to sell that business. The other thing is the coal business, which is really interesting right now. We'll come back to that a little bit later.
Yeah, it's the lab-grown diamond push in terms of the competitive squeeze and a lack of demand in China, it seems, not just in the Johnson household for diamonds.
No, I think there's strong demand.
There is strong demand in the Johnson household. OK, so that's the counter to that. Now, the CEO, Duncan Wanblad, will be on this programme, the CEO of Anglo, of course, at 8:15 a.m. London time, so stay tuned for that conversation.
We've got plenty of earnings conversations still to come on this programme. Sébastien Bazin, the CEO of Accor, is going to be joining us. Yesterday, Ben Smith of Air France was on the show talking about strong demand at the front of the plane. Are we going to see a similar story from Sébastien? We'll find out in just a moment. We're going to talk markets with Chris Watling. Longview Economics is going to be joining us. Marija Veitmane is going to be joining us from State Street. Is she still long tech? We're going to find out. And Catherine Nice from PGIM, fixed income, will talk to us about the European PMI data and, I suspect, the future of Christine Lagarde.
OK, talking of data, 9 a.m. UK time. We're going to get Euro area, followed by UK PMIs. That's at 9:30. We do get US PCE then, that gauge of inflation, as we've been discussing. Also GDP data due at 1:30 p.m. UK time. Plus, we will be getting US PMIs at 2:45 p.m. At 3 p.m. UK, we're going to be watching the Supreme Court then as they mull the future of Trump's tariff campaign. And later, Fed speak from Laurie Logan as well.
OK. Busy day coming up. We're nearly at the weekend. And the curling, which is going to happen a little bit later on. What else do you need to know? This morning, President Trump says he is ordering the release of government documents that, get this, discuss extraterrestrial life. We're talking aliens here. This after he accused Barack Obama of giving away classified information on the matter during a recent podcast appearance. In the interview, the former president said aliens are, quote, real, but added they're not being kept at Area 51. Andrew Mountbatten-Windsor, former prince and brother of the UK's King Charles, has been released under investigation after being arrested on suspicion of misconduct in public office. The arrest came after further details emerged of his relationship with the convicted sex offender Jeffrey Epstein. Mountbatten-Windsor has consistently denied any wrongdoing. King Charles issued a statement outlining his, quote, deepest concern about the matter and promised Buckingham Palace's, quote, full and wholehearted support and cooperation with the investigating authorities. And we mentioned it just a moment ago. Christine Lagarde has told the Wall Street Journal she expects completing her mission as president of the European Central Bank will take her to the end of her current term. This after a recent report suggested Lagarde will resign early to allow the current French government, i.e. Emmanuel Macron, to pick her successor before next year's French presidential elections. So what do you want to chat? Do you want to chat aliens? Do you want to chat Andrew? Or should we chat Lagarde?
Let's stay clear of Andrew.
Yes.
Aliens is tempting. Our producer putting out, Dan Curtis, pointing out the polymarket alien odds. Polymarket alien odds. Betting odds are about the same that the Supreme Court upholds tariffs, 25%, as US confirming aliens at 22%. Christine Lagarde says she's going to be staying in the post. At least that's her baseline.
Yes. So that was the line that stood out. That's her baseline. There are other possible outcomes here. 27 is the presidential election in France. We've already seen the Bank of France governor stepping down early so that the current government can position somebody new in that seat that will be there for a long period of time, and therefore whoever is the next French president will not be able to mess with that. The French system, it feels like it's sort of rallying round. You do wonder kind of whether or not there is a danger that we see maybe a little bit of credibility being undermined at the ECB if she were to go early. And this is an institution that has spent a long time trying to build up that credibility. And if you see politics slightly imposing itself on that, French politics in particular, does that undermine the credibility
Which would be
of the ECB?
the irony, because shoring up credibility and institutional independence seems to be part of the rationale for maybe making these moves ahead of any potential right-wing government in France.
Yeah.
Coming up, Donald Trump says he's talking about aliens. He's also talking about affordability. He says he has won affordability, but what will the numbers say? We're going to look ahead to the PCE data due later. Plus, Nvidia said to scrap its $100 billion long-term investment plan in OpenAI. They are investing $30 billion, though. We'll get more on the details ahead. Up next, we discuss the recovery in luxury travel with the CEO of French hotel giant Accor. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg.
Well, it's been pretty consistent for the last, I'd say, 3-4 years, and we have not seen, despite recent, recent press on, change in people's travel patterns, we have not witnessed that ourselves at France KLM. Point of sale US and point of sale Europe as well in particular premium, as I just mentioned, quite strong. We're not seeing anything in the near term that causes us any worry.
Ben Smith, the CEO of Air France-KLM, joining us yesterday talking about what he's seeing, particularly on the transatlantic routes, where he is seeing very strong demand. In particular, though, Ben's talking about the demand that he's seeing at the premium end of the plane, the front of the plane, basically. And that is where the very strong demand currently lies right now. A little softer at the back of the plane. Look at what Air France did yesterday. Its stock was up by 12%. Let's call it circa 12% at the end of the session on that demand story. In some ways, it's a very similar story over at Accor, the hotel company, where the high-end stays basically boosting the bottom line quite nicely. Yesterday, the company reported revenue for the full year that certainly met analyst estimates. Very strong Q4 RevPAR. What is RevPAR? Revenue per available room, particularly boosted by the front, by the upper end of the hotel story. The company's CEO is Sébastien Bazin. He is joining us around the table. Good morning.
Good morning. How are you?
I'm very well. How are you? How's the company?
The company is doing super well.
Yeah?
Yep.
Ben's talking about the front of the plane being strong.
He's right.
Yeah, and you see that in the same...
Anything which is luxury or kind of actually upper premium actually grows 3 times faster than the eco mid-scale. And what's so extraordinary about it is, I guess, the luxury clientele called us and they asked for the best room. Give me the best suite. They never, ever ask about the price.
Right.
So and what we regret today, we don't have enough great suites.
Right. So it's like having enough first-class... These guys don't have enough first-class seats. Precisely. You don't have... OK.
And it's been the case for the last couple of years, by the way. It's not kind of actually the last 6 months.
So it's sustainable. This is not... You're not seeing any wobbles in this story? There's no...
The price of a luxury hotel, if you compare to pre-COVID, 2019, times 3.
Right.
So you have like $1,000 average room rate in Paris. People pay today $3,000.
So what does it mean? You don't have enough of these suites. What does it mean in terms of acquisitions? What does it mean in terms of what are you doing to try and meet that demand?
Just go fast to the luxury segment. Go fast where the money is, which is the US travelers coming to Paris. Go where they spend the money. Go fast to Cannes, to Nice, to Greece, to Dubai, to Abu Dhabi. Reshift your thinking.
Yeah.
You have to cater for them.
What are you doing with the mid portion then?
Cash flow. That permits me to take risk. So the eco mid-scale is my cash cow. But if I want to grow faster, if I want to get a better margin, then you go to the upper luxury segment, which is what we've done 7 years ago. We reshifted Accor entirely from being kind of actually a big giant in eco mid-scale to be today a real player in luxury.
Is it just the Americans?
No, it's coming from South America, it's coming from Asia, it's coming from all over the world.
If we see a weaker dollar, does it...
Doesn't change anything.
Doesn't change anything?
Did not change anything last summer.
Do you think... At some point, do you think it will? Is there a lag? People make plans a year in advance. So you make a year in advance, then the dollar weakens, and you still go because you've already booked the holiday. Is there a lagged effect in that?
I think it does, depending on your wealth. If you are kind of actually a $20 to $30 million man, I guess, in terms of wealth, yes, you're going to pay attention to this. If you're above $500 million, you don't give a damn.
Okay.
That's what it is.
What's happening with travel into the US from Europe? Are you seeing evidence that there's that reluctance?
Still as slow as it was last year. People wish, if they want to go to America, they wish it from the US, they go to Canada, they go to Mexico.
That hasn't changed?
It hasn't changed at all.
There's still a reluctance from European travellers.
Well, there's a reluctance and there's a fear of kind of actually being stopped at the custom officers, looking at your phone. So it's a bit... I've been going to America every 4 weeks. They never actually touch my phone. They never ask me anything. So I think there's example of people suffering, but those are super anecdotic.
Do you think that continues?
In terms of fear?
That concern, that fear, that reluctance?
No, I think that should be moving away because that's not actually real. Well, this year, I hope for the summer. I need people to go back to America.
How big? Because you're talking about the World Cup, right?
World Cup's going to be extraordinary. As it is, anytime you have a sport event, you have sport bashing before, as we've done with the French Olympics, the Italian Olympics. Yeah. And when it starts, it's gorgeous. So you're going to have a great summer.
So how are you gearing up for the World Cup? And what is it going to mean for pricing? What kind of demand are you looking at?
We're looking probably 50% up versus last year on a similar year. So it's going to be significant, except I cannot actually add more rooms. So it's going to be great on pricing. Okay. But I guess...
Is there a danger that high pricing puts people off at some point?
Not really.
No, okay.
For the Olympics, that's not.
America's one story. What's happening in Europe? What's happening in Asia? To start with Europe.
Europe is back. And in terms of back, we have to be super careful. Europe was actually negative 1% last year, but it was back 3% up in the fourth quarter of last year. So you see a shift in Germany, in France, and in England, which I did not expect. So you're going from -3 to +1.
Why is that happening?
I think people have a lot of savings, and people are saying they're going to enjoy a little bit of it, they're going to spend it, and you have a big shift between ownership and experiences. People spend less on buying things, spend more on enjoying themselves. Entertainment, art, music, travel. So there's a bit of this.
Is that shorter-term trips?
I don't know. I hope it's not. But I guess what we've seen in January is continuing what we've seen in November, December. And that's a blessing. And it continues in half of February. So it looks like being promising for the next 3 or 4 months ahead.
So Europe is back.
Well, Europe is back again, from -3 to +1.
Yes.
We are +7 in the Middle East and +8 in Asia Pacific. So it's gradually back.
Yeah. You talk about Asia Pacific. Is China back? And
China's back.
China's back.
China is back. So we're back in positive territories.
And that continues. What does positive look like? What does the picture in China look like by the end of this
year? -12 first semester last year.
-12.
-5 second semester. It was almost 0 in December. Now +2, +3. Plus we have Chinese New Year now, which is actually packing. But it should be probably between 2 and 3% this year. What's so noticeable, China is back in terms of emitting market. 160 million Chinese left China last year, which is better than 2019. So they're back in Korea, Japan, Australia, Southeast Asia, which is great for me because we have the best hotel network outside of China.
Is India going to be bigger than China?
Yes. India will be bigger than China in probably 15 years.
Right.
They need to build up the infrastructure. Infrastructure doesn't exist in terms of hotel. The 5 largest group in India have 5,000 hotels together. The same 5 in China, they have 35,000 hotels together.
Right.
So, but it's...
so who's going to drive the demand in India?
The local.
Right, so that's a domestic market.
It's a 6.5% GDP economy for the last 6 years, probably going to be 6 to 7% the next 2 years. It's booming. We need to play, and we're playing with Indigo Airline, which is the largest airline in India, and we teamed up with them. So we have 78 hotels being done in 25 years. We should have 3,000 hotels in 20 years.
The number, Peter Elbers at Indigo shifts, the numbers of people and the expansion that's happening there is extraordinary.
There's the AI Impact Summit happening right now in New Delhi. Is your business, physical assets, experiences, is it immune from AI disruption?
Not at all. It's going to be very much impacted on before and after the stay. So all that customer relationship is going to be probably shifting hands from me maybe to an AI tool. I need to be playing with ChatGPT, which we've announced a couple of weeks ago. The biggest ever partnership being done by a hotel company with ChatGPT was Accor. We're testing the advertising, that AI agent on travel concierge.
And you reduce hiring as a result of that?
Well, not yet. That's going to have a major impact.
That comes, does it?
That will come. But at the same time...
By how much?
Well, we don't know. Probably by 15 to 20%. Anything which is repetitive, automation, HR, legal, tax, revenue management is going to be replaced by AI. So I need to basically, not being in denial, but train my people to do something else within the hotel.
But there's a 15 to 20% reduction in headcount, potentially as a result of this.
Likely in the next 18 months to 2 years. It's going to come very fast. Wow. But that's going to be lesser cost for the owner and lesser cost for me. But I need to take care of those people.
Just very quickly, what does it mean for the OTCs, the online travel agents?
They need to worry, but they're playing the game as well. So don't you worry. Whether it's Booking, Expedia, and us, we're all adapting to AI. The only thing we have to do is just think that, I guess, be there early. Because if you wait, you're going to be damn late. It's going to cost you a fortune.
You've got to invest. You've got to take the risk.
You're going to invest, but you need to talk to each of them. Because you don't know who's going to be the winner between Gemini and OpenAI. You don't know. So play them all.
Fascinating conversation. Sébastien, thank you very much indeed. Sébastien Bazin, CEO of Accor. Coming up, Chris Watling from Longview Economics on why the dollar is heading for its best week in months. That is next. This is Bloomberg.
Welcome back. Friday morning, 30 minutes to go until the opening trade. US futures are positive. European futures are positive. US futures, S&P up by around 0.3%. Eurostoxx 50 up by 0.4%. So we'll take that as a win. Let's check in on the bond markets. Not a huge amount of activity right now across the sovereign debt of the Eurozone. Treasury is largely unchanged as well. German 10 years currently yielding 2.73. OAT's 3.30.
and BTP's over in Italy, 334, as we continue to monitor the developments around Christine Lagarde commenting to the Wall Street Journal that she continues to see the base case as fulfilling her 8-year term.
Yes. I'm not going anywhere, despite what's happening in French politics. We'll see whether that turns out to be the case. Oil moving higher this morning once again. President Trump saying Iran has 10 to 15 days at most to reach a deal over its nuclear program. And the US is assembling an array of forces in the Middle East that could certainly do some damage. Let's bring in Anthony Japala, our Middle East energy markets reporter. How much risk is now priced in? Like, we're at, 72 Brent. Is that enough to price in the risk, or do you think there's more to come?
Yeah, good morning, Guy. We started this in the low 60s, and a lot of the analysts that we were talking to in the market were saying that there's anywhere from $3 to $10 of potential risk premium due to the threat of a conflict against Iran. So we are kind of at the top of that range now of that risk assessment. And speaking to some of the traders in the market today, they're saying, this is priced in. The risk of an assault is priced in. Of course, if there is an actual attack and we do see missiles flying and bombs falling, then traders will reassess what is the risk to actual exports and supply infrastructure. And if there is any real hit on supply or any interruption to exports, then we could stand to see oil spiking even more. So people will be looking at that, positioning themselves in the market to be prepared for that. But really, it looks like we are at the top of that kind of, 3 at the low, 10 at the high end of the range for that risk premium there, with the potential to go even further should a hot war start.
So 10 at the high end, but could go further, Anthony. What are you hearing from traders about what would happen in the worst case scenario, at least for the oil markets, the worst case scenario, which is the closure of the Strait of Hormuz? What kind of pricing action could we see on that scenario?
Yeah, a lot of the discussion that we've been hearing over the last few weeks as we followed this is that oil would be easily towards 100, if not higher than that. We've heard of some people talking about the price doubling into the 120 range. We were in the 140s last time in 2008 when there were some supply interruptions. So that was when we hit the all-time high of oil at that time, and we saw oil in the 120s during the Russia's full-scale invasion of Ukraine just a few years ago. So we have seen oil moving around a lot, lots of volatility. When we're not kind of locked in that range where oil doesn't move between, say, $60 and $70, $75, we've got a lot of this volatility. We were expecting this year would be a lower price environment because we've seen lots of oil coming to the market after OPEC opened the taps, pulling back some of its restrictions last year. Saudi Arabia is up to 10 million barrels a day right now, so that's just 1 million barrels by itself from Saudi Arabia that's added to the market. So we've seen more oil, but that glut has not really impacted the market because we're being elevated by this geopolitical risk, Tom.
Anthony, we're going to wrap it up there. Thanks very much indeed for kind of setting it all up for us. Bloomberg's Anthony Japala joining us on what is happening with the crude market. We're at kind of 72 now on Brent. We could go to 100. What would 100 do to the global economy right now? What would it do to risk assets? What
would it do to equities? To your point, let's bring in Chris Watling then. Global economist and chief market strategist at Longview Economics. Chris, $100 a barrel oil. If that's where we get to on a conflict with Iran, what does that do to the equity space?
Well, I mean, the initial impact is negative for equities. The question is whether you stay at $100. Well, I mean, these stories go... I mean, every year we've had the story about closing the Straits of Hormuz. I mean, since I've been doing this job, every year Iran's going to be invaded, every year the Straits of Hormuz are going to close.
So it actually happens, though?
And it never happens. And it hasn't happened. It might happen. It could, of course, happen. And if it does happen, there will be implications. But I think we should also remember, every geopolitical event in the last few years where you've had a spike in oil, basically it peaks on the event and then sells off oil. So actually oil's been in a downtrend since the Ukrainian war because there's a lot of oil around. There is a lot of oil. Now, of course, if you take out the whole Iranian supply, that's an issue. But if if it's quick, it really will pass, and it's an opportunity to sell oil and sell energy assets.
You would sell on that?
You sell on the news.
That's been
if it's a good invasion and it's quick and it works well.
Okay, that's what Trump's looking for, but he's positioning for a longer-term picture. So let's park the geopolitics one now for the time being. Oil has been a big contributing factor, though, to what we've seen in terms of the disinflationary story in the United States. Even if oil just goes sideways, the base effect comes out, and maybe you see, therefore, a tick higher in terms of the inflation narrative. Talk me through the implications of that.
Well, that is true. Oil has been part of the disinflationary force, so yes. But I mean, for oil to stay up here, it seems unlikely to me. It's either spiking or it's going back to where it came from.
Okay.
Because of the fundamentals. So either geopolitical events are taking over, or it's receding. But look, I mean, the U.S. economy is basically disinflationary in general. Oil's part of the equation, but there are other parts. You know, there's spare labour, rent is running at its 10-year.
So the Fed should be cutting rates?
The Fed should be cutting rates, and I think it's, as absent the oil price risk, it should happen, and the market's priced it in already. So,
do you think the market's backing away a little bit from that?
Not as of yesterday morning. I don't know what they're doing overnight, but
a strong tips auction, markets. I'm hearing more and more people saying the Fed shouldn't be cutting rates this year.
Well, it's a
just anecdotally.
It's a fine. It depends which part of the K-shaped economy you look at.
Yeah.
Right? You look at the top half, you'd say, well, why would you bother? You look at the bottom half, and arguably we're in a bit of Goldilocks. So why not cut?
Okay.
I mean, Kevin Walsh turns up, tries to do a bit of Greenspan's productivity story from the late 90s. Growth is strong and it's disinflationary. So if you're entering a deflationary productivity boom, there's every reason why you should cut.
What would that mean, that outcome? What would it mean for the rotation that we're seeing? Is the rotation in US stocks starting to, into cyclicals and defensives and out of tech, starting to look a little stretched?
I think it looks a little stretched in terms of chapter one. The question is there'll probably be lots of chapters. We haven't had a proper broad cyclical recovery in the West for several years now, probably since 2021. So it's not going to be a short-lived affair. But the market's priced in chapter one, yes. The market's very stretched on lots of sort of cyclical overbought type measures. But the real question is, are we rotating in this sideways market, or are we preparing to roll over with a bit of bout of volatility? I think that's the real question. But
do you have an answer to that question?
I have a sense of what. I mean, I don't think anyone has a definitive answer.
Because so what's your sense?
My sense is, the macro environment for the US and global stock market is really good, and therefore you want to take advantage of any softness. We shouldn't have too big bouts of volatility because actually the corporate sector looks pretty good in the US. It's quite strong. Net debt's at record lows and cash flow is good. So volatility should trend at low levels. Therefore, we shouldn't have big pullbacks. So
why am I seeing single stock vol as high as it is, and why am I seeing index vol as low as it is?
Well, that is one of the key risks at the moment. There's a lot of damage under the surface in single stocks.
Yep.
Software, anything disrupted by AI, as we've seen in the last few weeks, getting taken out. So that is a concern, and that has created a bit of a risk, and that's one of our models that's signalling a bit of a warning signal. So that needs to be watched closely. I think really what you're talking about is people taking single stock damage and being told to take down their gross, basically de-risking.
Yep.
That's clearly a risk. But as I said, the macro's so good that I think any sort of wobble is an opportunity to put money to work.
Including in tech?
Great question. I actually think I think software's definitely due a bounce. It's so oversold. I wouldn't be surprised if it was up 10% in a few weeks. But whether or not that 10% continues, I really don't know. And you've got to ask someone who's a tech, software, AI specialist, and that's not my ballgame.
Are you worried about what's happening in the private credit space right now?
Well, yes and no. I mean, I think it's a long-term problem. I think there are things brewing. I worry about things when money's tightening up, not when money's loosening. When money's loosening, you can cover up all manner of problems.
Why is the Fed talking about hikes, then?
Is the Fed
talking about money? The last minutes, people, the minutes highlighting the fact that there is a discussion. There are some on the FOMC that are talking about it.
Yes. Well, they're probably looking at Australia and wondering about the top half of the economy and so on. There's a big debate out there. There always is. And the whole global economy has been very weird post-COVID, and it remains abnormal.
If bond
and I think that's confusing people.
If the 10-year starts to move higher from here, how big a risk signal would that be for you?
I think that's a great signal. That's telling us the market believes more in growth, and I think it will start doing that because the curve's steepening.
Yeah.
Well, then Wall Street's worried about getting to 450 on 10 years or 475. I think in 2 years' time, 10-year yields will be at 6%, and then it'll be a problem. I don't think it's a problem along the way. I think it's simply telling you that growth's getting better.
So 6% in 2 years on a US 10-year?
Yeah.
Okay. I'm just marking that down.
What does that do to the 10-year gilt in 2 year time?
Well, it's 30 bips higher than that probably.
What does it do to the S&P in 10 years' time?
Yes.
Well, the point is it's going up because of growth. It's not going up because of inflation. This is a very different world from 21 and 22.
If you have this much growth, are you sure you're not going to have inflation?
Well, I think you'll get it eventually, and by the time we get to 6%, it will be a problem.
OK. So inflation is coming.
I don't know whether
inflation
it's 5.5 or 6.25 or whatever, but my point is it's not 4.5, 4 3/4 or 5.
So the 10 years mispriced right now?
No, it's not mispriced right now.
Okay.
Its price will change. That's the point. We're entering a global cyclical upswing, and we'll start getting momentum. Watch ISM manufacturing. That should rally to 55, 60 over the next 18 months.
Yep. We're going to watch this one very... I'm going to write this down.
Don't write anything down, I say.
Chris, great to see you. Thanks for talking about the CEO. Chris Watling, global economist and chief market strategist at Longview Economics. Coming up, talking of the Fed, Minneapolis Fed President Neil Kashkari pushing back against National Economic Council Director Kevin Hassett's criticism of a new New York Fed paper on tariffs.
I thought that Director Hassett's comments, though, he went on and he said that he disagreed with the results and the researchers should be punished or they should be disciplined for their conclusions. I think this is just another step to try to compromise the Fed's independence. Over the last year, we've seen multiple attempts to try to compromise the Fed's independence, including in December when the Department of Justice served a subpoena to the Board of Governors over some building expenses. It's really about monetary policy.
Stick to the knitting. More on Fed policy next. This is Bloomberg. We are, 12, 13 minutes away from the start of trading this morning. Futures look pretty positive. They look pretty positive on the other side of the Atlantic. We've got a lot to get through, though, in terms of what we are watching out of the United States, in particularly the United States, with the data that we're going to get. PCE, I think, is going to be really interesting. Yes, it's delayed, but inflation seems to be the story everybody's talking about right now. Let's talk about what we are watching and where we are going to go next. We've also got the geopolitical risk that we need to fold into all of this, too. Paul Dobson, Bloomberg Executive Editor for Asia Markets, joining us to discuss how markets are feeling this morning. Paul, I don't know what's going to happen this weekend. I don't think anybody does. Maybe President Trump does. Geopolitics is dominating. The oil price is climbing. How big a risk to risk assets is this?
Good morning, Guy. Well, I was joking with my manager a while back, telling him, we've got the risk of a collapse of the British monarchy. We've got the brink of a war. We've got private markets under extreme pressure, possible threat of an alien invasion. Asian index gives back 0.3, 0.4%, and US futures rally. So far as today's session is concerned, risk markets are taking it relatively in their stride. Where we are seeing the pressure play out is in the crude oil market. Of course, we've got Brent crude pushing up out of the range to the highest levels this year. And so that does tell you that there are some nerves out there. But the communication from Trump seems to be around this idea that there's another couple of weeks worth of negotiation time before we would get to any kind of action. And the market seems to be relatively comfortable with that. Yes, we did have a little bit of a risk off in the US session yesterday, but the gains in the futures today sort of have erased pretty much all of that already. So at least as far as Asia is concerned, the risk sentiment is still looking pretty resilient and strong.
Paul, the list of risk factors then for these markets, I love the way you illustrated it. So aliens and an alien invasion. So let's go there, Paul.
How do you price in that?
How do you price in an alien invasion, Paul? Oh, OK, private credit, Paul. Blue Owl is in focus. The whole space was under pressure. Stock selling off yesterday. How much of a risk is this, do you think?
Yeah, nobody really knows. And that's the biggest problem, isn't it? There's so much opacity within that market. And so some people are crying wolf, saying that, oh, my goodness, they've shuttered some funds. This is exactly like the start of the financial crisis. Others are much more relaxed, including the private credit companies themselves, which are saying defaults are extremely low, and the track record so far would seem to prove that. But we don't know exactly what that exposure looks like. And the fact that there's a lack of obvious data out there by the very fact that it is private markets is one of the things that has markets worried. So that's why we're seeing those stocks of asset managers rattled and worried a little bit about what the contagion might look in the rest of the market universe.
In terms of kind of where we go next, what are you watching, Paul? We've got Asian markets beginning to come back. How big a factor is that in terms of broadly what people are thinking about? You've got US data we're going to be watching a little bit later on. What's caught your eye this morning in terms of the market moves you're watching?
Yeah, so I think that the China return is going to be interesting. We've seen a couple of the AI startups really rallying hard today, Minimax and Zhipu, but we've seen those platform companies still under pressure. They've been trying to drum up business, but nonetheless, Alibaba, Tencent still fading. And I think that speaks to the weakness within the Chinese economy. So it'll be very interesting when they start trading again on Monday to see just how strong the markets can hold up there.
Paul Dobson, Bloomberg's executive editor for Asia Markets. Remember, you can get up-to-date analysis and insight from the Markets Live team. Just go to MLIV, MLIV Go on your terminal. Paul, thank you. Let's bring in Chloe Melly right now with stocks to watch this Friday. Chloe, what are you focused on?
Good morning, Tom. I'm focused on Danone to begin with. So the sales came in higher than expected, and that is thanks to two things in particular. So really strong demand for medical nutrition products and also very strong demand for high protein products like yogurt. And so these strong results could really help lift the shares for Danone this morning. We can see they have been trailing peers a little bit. Some of that weakness had to do with those infant formula recalls that have really weighed on the stock price. But Danone said today that those recalls would have no material financial impact on the company. So that could be seen as reassuring, and combined with those strong results, we could see the shares moving higher this morning. Moving on to Anglo American, which took yet another write down in its struggling diamond unit. So the profits are steady for Anglo American, but it looks like the restructuring plan, the transformation plan, is taking quite a while and is being quite difficult to deliver. The plan is to exit coal, platinum and diamonds, and so far it's only managed to exit platinum and is still stuck with coal and diamonds. But beyond this restructuring plan, what investors have really focused on lately is the deal with Teck Resources, which will create one of the world's biggest copper miners. So that explains this massive rally that we've seen in the shares. But we'll see if investors today decide to focus on this impairment charge and results. And finally, Aston Martin issued another profit warning. And so this really highlights how difficult the turnaround is going to be for that car maker. This is really going to be about tariffs. That's what the company has said today. And we can see that the shares are already struggling quite a bit, and so this could be yet another issue for the company, and highlights how difficult 2025 has been for that car making industry really across Europe.
Okay, Chloe. Thank you very much indeed, Chloe Melly, with some of the stocks that we are watching this morning. It's going to be interesting to see how the oil stocks trade today.
Yep.
Is there an expectation that we do see some stickiness around the oil price? If we are going to see a more prolonged conflict, would oil stay up? Or would it do, as we've been hearing on the programme, just sort of come up and come down? How much can you price into some of the oil names in Europe if we get the shorter kind of spikier trade? If it gets something longer, do you see a more sort of consistent pickup in some of these oil names?
Yeah, Chris Watling was talking about the fact that in recent history, of course, you have seen that move lower after these kind of spikes. But Anthony Paula over in Dubai from our Bloomberg team talking about levels maybe $100 if they close the Straits of Hormuz. That remains, of course, theoretical. There's some lines and data out of the UK, which is broadly positive, Guy.
Yep.
So, consumers are spending. So retail sales beginning the year with the fastest growth in 20 months. That's good news for the Chancellor. The other piece of good news for the UK Chancellor is what's happening in terms of tax revenues. And part of this is down to capital gains taxes coming through, but also lower debt costs as well.
Yes, but we've just been also hearing that the fact that maybe you start to see globally bonds moving higher, what gravitational effect would that move have? You're already starting to see that. The Bank of England is still expected. And the data is pointing, and Kathy Mann was out talking about the data yesterday. The expectation is that the Bank of England will be cutting. Just how far does the Bank of England, can the Bank of England go, I think does remain an open question. Inflation is going down, but it's still elevated. We're still kind of at 3%. How much room for manoeuvre does the Bank of England really have? How far can rates go down if we are going to see maybe the global central bank cycle bottoming out at this point? So there's some room for manoeuvre, but not maybe that much room for manoeuvre in terms of what we're going to be seeing. We're also going to get data in the next hour in terms of the PMI data. Yes. That's going to be really interesting to tell us what's happening over at the ECB and what we're seeing in terms of the European story. Yes. So that data, we're going to get France, we're going to get Germany, get Eurozone data a little bit later on. It's going to be really interesting. There's a budget that's been passed now in France, so some of that risk has been taken out. And are we starting to see green shoots for that German economy on the fiscal impulse? That data will be broken. We'll give you the context as well. Coming up, it's the opening trade, of course. Futures in Europe after a challenge day yesterday, pointing higher by 0.3%. Stay with us. This is Bloomberg. Morning, how you doing? A couple of minutes to go until we see the opening trade here in Europe. This was yesterday's session over in the United States, yellow line where Europe goes out. The US finished negative yesterday, but only just a little bit down in terms of the overall session, which was actually quite choppy. Europe went out here kind of similar levels to where we saw maybe the closing price on Wall Street, so maybe not a lot of a read-through here. But the choppiness is interesting. This market continues to churn, and that is the story at the moment. It's not an index story, it's below the index story, and that's what we're watching once again. Eurostoxx 50 futures are up by 0.4%. The FTSE up a similar amount. The DAX is up a similar amount. We're about to get a fair amount of PMI data in the next hour. That could be something that moves these markets. You're going to see some single stock stories that I think are worth paying attention to. Keep an eye on Anglo in particular. I think that's going to be interesting. But at the moment, these indexes are not necessarily telling the whole story. It's the churn below the indexes at a sector, at a single stock level, that I think are the really interesting tell on where sentiment lies right now, Tom.
On some of those individual names, you mentioned Anglo then, Guy, coming through with that impairment then, pre-tax impairment of $2.3 billion on the diamonds unit. De Beers, of course. Top line in terms of the profits, staying steady, essentially, underlying earnings of 6.4 billion. But the focus, you would have thought, from many investors will be on that impairment and how they work through the diamond challenge. Of course, they do have that additional exposure to copper. Danone, in terms of the earnings, looking pretty solid. Sales rising. They're getting a boost from high protein and medical nutrition demand, and not seeing a material impact as a result of recalls in the US. Aston Martin, and you're seeing just another profit warning. Again, they are citing the impact of tariffs, Guy.
Bad day for Bond. OK, let's move on and talk a little bit about what is happening with this market open. We're expecting it to be positive. We're expecting some really interesting single stock stories. But let's take a look at the index level to start with and talk you through what is happening there. We're expecting the FTSE 100 to be up a little bit, but not by much. We're expecting 0.2% maybe from some of these indexes in Europe. That's what we're basically getting out of the FTSE 100 already. Let's see how the miners do this morning. Let's see how the oil stocks in particular do as well, as we watch what is happening in the Gulf and this build-up of US military kit in that space. Stock 600 is up by 0.2%. The DAX clearly has no news this morning. It is up and it's out early. Clearly nothing is happening in Germany. The CAC is up, though, more than most. It's up by 0.5%. The IBEX is up by 0.3%. Clearly a very quiet morning for the German market. You don't normally see the DAX open by this point. Tom, what do you got?
On the sector-by-sector breakdown, Guy, consumer products at the top of the list, gaining a little over 1%. Construction up 0.9%, and chemicals up 0.7%. On the downside, utilities a little softer. That is the biggest loser across your sector so far. Alongside autos and Aston Martin, part of the mix there. Autos down 0.3%. That's the sector-by-sector breakdown. Interesting look at the FTSE 100. We keep an eye, of course, on what's happening in the energy space, given higher oil prices. But energy as a sector is actually down 0.2%. Some of the gainers on the FTSE 100 include some of the financial services firms like St James's Place, which is up 3.6%. Also the luxury stocks, Burberry getting a bit of a lift, gaining as well. What are you seeing, Guy?
Yeah, LVMH is the biggest points gainer, the upside. That's what we're seeing in space. I wonder whether there's a sort of certain read across Maybe this is China. I don't know. I'm curious to find out exactly what's going on there. Maybe Air France, Accor telling a positive story about what is happening with the kind of the ultra-luxury story. Maybe that gives us a boost. But it's LVMH, it's Richemont in that space that are doing well. As you say, you are seeing a fairly mixed bag elsewhere. Some of the pharma stocks are coming through. Nestle is down. Which I think is interesting. I think Infineon's XD today, so that's probably just worth noting too. But the churn continues, and I think that really is the narrative that we're watching once again. Single stock volatility remains a big theme. Churn within sectors remains a big theme. Equities at an index level just going sideways. But tech has been a big theme, and this big sellout we've seen, particularly in software stocks over recent days, has been this growing narrative. Marija, Veitmane, head of equity research at State Street Global Markets, joining us now to discuss. Marija, fantastic as ever to see you. How are you feeling about tech?
Yeah, good morning, Guy. Good morning, everyone. I mean, what we're seeing about in tech is kind of rotation from tech to tech. That's kind of the tagline we're going with. So we see quite a big rotation from software into hardware. So that trade is very prominent. We also see rotation from US tech to Asian tech. So the kind of investors kind of moving money to places like Korea, like Taiwan. So it's not kind of people getting out of tech. It's just choosing where you see more clear monetization, where you're seeing kind of winners and losers from this kind of AI arms race.
What do you think about what is happening with the Magnificent Seven, though? There is serious concern, serious kind of the narrative. You see Microsoft coming down. That's the kind of the software side of things, but maybe a little bit of AI spend stories as well. Elsewhere, you're getting a divergence between Microsoft and say, Alphabet. What is happening within that key group, which is so determines what happens at an index level, particularly in the States?
So, I think there are a couple of points to make. I mean, the first point to make is that, so Q4 earnings, that's kind of been market seen it as a little bit of a catalyst for sell-off, but as kind of CapEx, huge continuation of expansion in CapEx. But other than that, we saw very significant earnings, and on capex, particularly for Magnificent Seven, what we're seeing is that capex is enormous, but the cash from kind of operating cash flows are still twice as much. So ability to finance this capex is still there. So we're not kind of getting any more negative on that. But it's very clear the rotation within the sector. So I think the kind of good analogy is kind of if you're thinking about waterfall, you don't want to be on top of the waterfall with kind of LLMs of this world. You want to be towards the bottom waterfalls where this capex is trickling down and who is kind of benefiting from this huge spending. And that's kind of your hardware side, your semi side, but also, materials, industrial. So companies who feed into this capex, AI capex are benefiting from that. So kind of AI enablers, that's potentially kind of the new trade.
Is it new though, Marija? I mean, how wide is that window? How much further does that trade have to go?
That's a good point. So that has been happening maybe for the last kind of 3 months, but if we compare investor holdings, say in, capital goods or materials, they probably 3 or 4 times lower than what we see in tech sector. So that definitely can continue. Out of emerging markets, so we saw money going out of, like, say, US into Korea. Again, holdings in Korean stocks. I mean, Korean stocks done fantastically well, but the holdings, investor holdings are about 4 times lower than in US. I mean, I'm not suggesting that they're going to go to exactly the same levels, but that kind of gives you the degree of magnitude. So, so those trades are reasonably kind of recent. So we still see continuation of that demand.
We know notoriously it's difficult. I want to shift from the tech story to what's happening geopolitically, and notoriously difficult to price geopolitics. But would you want to be placing any hedges on? Would you want to be looking at other asset classes or other parts of the equity market in light of the tensions around Iran?
Yeah, that's a really interesting point. And I think what we saw for a good part of, like, towards the end of last year and kind of start of this year is that I think those geopolitical stories are really notoriously difficult to price in a sense that normally what we'll do as kind of as analysts is that you look at, okay, something happening in geopolitics, and then you do your case studies. If this happens, these assets will do well. If that happens, these assets will do well, and then you assign some probabilities, and you kind of build your portfolios this way. I think right now it's almost impossible to assign probabilities to any outcome, given how quickly those narratives change. And I think what investors are doing, have been doing throughout most of last year, they maintain their core risk bets within tech, emerging markets. That trade continue. But what they did, they bought a lot of kind of precious metals, so that seemed to be kind of the favorite hedge, and kind of within equities it's been kind of mining stocks. So that was kind of, so you had this like really strange situation where the kind of gold as a kind of proxy for risk done really, really well, like your safe assets, and at the same time risk assets done very well. So investors did not change the core of their allocation, they just hedged it with kind of precious metals and kind of carried on with risk positions.
Marija, what do you make of what is happening at a single stock level and a sort of a sector level and an index level? Indexes are going nowhere, but below the surface, I'm getting a lot of single stock volatility. And I'm wondering what you make of this. Some people saying it's nothing, this is normal churn within a market, but it's very aggressive churn. And I'm wondering whether or not this is a signal that we should take note of and should be concerned about. What do you make of this divergence?
Yeah, I think the first point to make is absolutely we're seeing this churn. We actually have an index that measures this kind of weirdness of the market, so unusualness of the market. We call it correlation surprise, and it's absolutely been kind of quite elevated. Last year came off a little bit towards Christmas and then started to go up again very, very strongly now. So that's definitely there. It's not at the highest level we've seen, so that potentially can continue. I mean, historically, that tends to kind of predict spikes in overall volatility, so that's something to take note of. And I think the way investors take note of is through those hedges in the kind of precious metals. So they do those kind of unusual things that makes the whole system potentially less stable. And we see this kind of very elevated positions, A, in risk trade, but B, in safe trade, but not much in the middle. So that I think the way investors playing it. And I struggle to see that going away, given that geopolitical risks are probably kind of a feature, not a bug these days.
Marija, on the regional question, in terms of regional exposure, we get a lot of guests on who like the European story for all number of reasons. Rates at 2%, fiscal stimulus from Germany, green shoots. You push back on that. I mean, particularly around the small caps. This is not a space you want to have exposure to.
Yeah, I mean, the problem we have with Europe is it's really just green shoots, and as opposed to kind of strong growth. I think, like, I mean, in Europe, last couple of years, we flirted with recession. I mean, this year it's slightly more positive, but I don't know what GDP growth forecast is. I mean, still less than 1%, 0.5, 0.6. I mean, if we were talking about these numbers in US, we will be pulling our hairs out and talking about recession. So it's still not the level of earnings growth. And also, I mean, the important point about Europe to make is that last year, European stocks performed really, really well on hope of earnings recovery. So multiples re-rated, earnings recovery has not happened, has not materialized, earnings still contracted. So we're still kind of, we priced like this kind of earnings already, and they're not happening. So to me, that's not a region to be very excited about.
Marija, I hope you're enjoying the Olympics. Thank you very much indeed for joining us. Marija Veitmane, the head of equity research at State Street Global Markets, joining us from Milan. Let's talk about what we're seeing in the core six right now. This is the picture. A game of two halves. Novo, LVMH and Rheinmetall all trading higher. I think there's a note out this morning on European semis, which is worth paying attention to. I think it's from Bank of America. ASML is soft. Schneider's down. Nestle seeing some softness as well. Let's go from LVMH, which is up quite nicely, to a stock that's really driving this space this morning, which is Moncler. Chloe Melly's got more.
Good morning, Guy. Indeed, Moncler is having a great day today. We're up more than 12%. This is the maker of high-end puffer jackets, and it reported full-year and fourth-quarter revenue that was ahead of estimates. And especially, there was a lot of strength in the Chinese market. And so that has been driving the rest of that luxury sector higher. And as you just mentioned, LVMH also higher on the back of that. Another name that is definitely in the green is Kingspan. This is an Irish construction company and generated record revenue in 2025. And that was thanks to very strong demand demand in data centers, and that helped to offset some of the weakness in the residential end of the market. This is something that we've seen with other names in that infrastructure construction sector in Europe, like Vinci or Skanska as well, where they had those really strong data center customers that were offsetting some of the weakness elsewhere. And therefore, for Kingspan, we're up almost 9%. SJP, St. James's Place, is also up this morning, about 2%. That is after UBS upgraded the company to a buy rating. So St. James's Place was one of those companies that was really hit by that sell-off in companies that are exposed to AI disruption. But UBS analysts are saying that the valuation is very cheap, and so that makes it very attractive despite those AI risks. And finally, let's end with Danone, which is a little bit weaker. It was a little bit weaker this morning, despite those strong sales, despite the fact that that they are saying that the infant formula recalls will not have a material impact, but management has just said that that impact will be as much as 1% on net sales in the first quarter. And so that might be what the market is reacting to this morning. And we are down a little bit, about 1.2% for Danone.
Chloe Milley, thank you very much indeed on some of the stocks on the move, earnings in focus. And coming up, we'll get another earnings story. Anglo American taking a big hit on its diamond unit. The stock is currently up just shy of 0.1%. We're going to be speaking to the CEO of that major mining company. That's coming up next. This is Bloomberg. Welcome back. We have some breaking data out of France. PMI, Manufacturing Purchases Index, coming in slightly higher than the forecasts, 49.9. The forecasts have been for 49.6. That's for the month of February. That's the composite number. Worth zeroing in on the manufacturing component. That's coming in slightly softer, modestly softer than, well, a fair bit softer than the survey. 49.9. The survey had been for 50.9. Services coming in stronger, though, so 49.6. The services seeing a bit of a lift. There's a bit of divergence between manufacturing and services, not extreme, but services coming in slightly stronger than the survey, but manufacturing softer, certainly than the survey. The composite number coming in, rounding out 49.9, Guy. The euro is currently at 117, not a huge move.
OK, so this is the line that we're getting in terms of the press release that we get with the market PMI data. France's private equity, private sector economy continued to lack any impetus for growth. February's flash PMI survey data showed with business activity levels basically unchanged at the beginning of the year. Stagnation was also seen in employment after back-to-back months of expansion either side of the new year. Basically, the French economy is going sideways at this point. There's some upside in the idea that maybe actually we're getting some political stability, but it's not yet maybe being reflected in terms of the economic data that we're getting. We're basically at flat. We're kind of flat 50. Let's call it 50. The French economy is going nowhere in a hurry.
Yeah,
and
it's hard to see what the next catalyst is for the French economy. You can look at catalysts for the German economy, for example. It's hard to see where it comes from. They have pulled out some of that, or at least washed out some of that political risk, at least for now. To your point, the budget has passed. So maybe things start to turn around. Maybe there's a benefit and some uplift that comes through from the German fiscal spend.
So where do you get the momentum from? What is it that could cause momentum here? You're also potentially facing a stronger euro, which is going to be a factor as well. I know we're off the recent highs. People were talking about 120, but that we're fading off the back of that. So we've got 117 right now. But it's really hard to see where the catalyst comes from in terms of the French economy right now and what happens next. Clearly, we're also coming into a period when we're going to start thinking this year about the 27 elections. And that's going to be a factor that is also going to weigh as well. Who will be Macron's successor, I think, is a question the French economy is increasingly going to have to deal with as we work our way through 2026.
And that's certainly a question that seems to be percolating through the halls of the ECB as well.
As we think about who could... Does Christine Lagarde go early or does she not go early? So that's what we're seeing in terms of the macro data. We'll bring you more PMI data as we work our way through this hour. Let's return now to what we're seeing in terms of the corporate news. Anglo American has taken a $2.3 billion impairment charge on its struggling De Beers diamond unit, which, remember, it's trying to exit at the moment. Across the group, Anglo reported a 2% rise in underlying earnings from continuing operations. Joining us now, Duncan Wanblad, the CEO of Anglo American. Duncan, thank you very much indeed for your time this morning. Where should we focus in terms of the business? Should we focus on the kind of the jigging you're doing in terms of the portfolio, should we focus on the concerns around what we're seeing in the diamond business, what's happening in coal? What bit part of the business takes the greatest amount of your time right now? And where do you see these results in a year if we do see the ongoing restructuring continuing? Where are we in the journey, I guess, is the question I'm really asking.
Good. Well, it's a great question. Thanks for that. And I guess the answer to it is I'm focused on all of those areas. I mean, we started out with a very significant turnaround in the business, focused on making sure that we operated the assets that we had under our management to the best of our abilities. And I think that that's absolutely starting to show through, particularly in the retained businesses. And at the same time, there were a number of reasons that we needed to reset the portfolio, and that's a process that has really progressed very well with the demerger of our platinum group, which is now Valterra Platinum. And of course, we've got our nickel business that is just waiting for EU approvals before it can close. We're now well progressed again with the sale of the coal business. And then, as you mentioned, diamonds is the business that is taking a little bit longer, as we had expected to do, just given the nature and the shape of the diamond markets today. So that is going on, and that's going very well. At the same time, having now announced the deal with Teck and the merger with Teck in September of last year, having now received the shareholder approvals on both sides for the deal to continue. We've gone a long way down the line of regulatory approvals. We've only got 2 left to go. Yep. And all the focus is on how we integrate these businesses when completion does come.
Okay, let's just unpack that a little bit. Let's start with the tech side of things. What indications do you have from Chinese regulators in particular about how they're going to treat this deal?
So we said at the time of the announcement in September of last year that our expectation was that the time to completion would be somewhere between 12 and 18 months. So that would put us somewhere between September of this year and March of next year. And I believe we are absolutely on track as far as that's concerned. So we have had no indications from China, either positively or negatively. We are in a process with China, and this is moving at the speed and the pace that we expected it to do.
On the diamonds business, on De Beers, Duncan, you talked about the complexity given the market. What is your sense as to where we are in the market journey, where we are in terms of that competitive threat, the softness in the Chinese market? When do the conditions become good to get this across the line?
Yeah, look, a number of things are sort of impacting. I think this time last year I said, well, we were slightly hopeful that we were starting to see some green shoots insofar as we were starting to see a net positive inflow of diamonds back into China. We were seeing very, very robust activity for polished goods in India, and the US was stable to improving. So these are 3 key big markets for diamonds. But at the same time, of course, we saw massive production increases, particularly coming out of Angola during the course of the year, which put quite a lot of pressure on pricing. And at the same time, the lack of a trade deal between the US and India resulted in a 50% tariff on all Indian goods, and the vast majority of rough diamonds go to India for cutting and polishing. So those were sort of the impacts during the course of the year. But the fundamentals in terms of what changes diamonds, I think, is just the time it takes for hopefully this trade deal to be done. But secondly, the time it takes for consumers to fundamentally realize the difference between lab-grown diamonds and natural diamonds from a value perspective. And certainly we are seeing that today. So the production of lab-grown diamonds, the costs are very, very low. The consequence of which is, you can't defy gravity in terms of an unreasonable margin against the cost of that production forever. And we are certainly starting to see that change shape, but it will have to fully change shape. And then we'll have 2 markets. We'll have a natural diamonds market, and we'll have a lab-grown diamonds market. And our expectation is that in a few years, that's where we should be.
in a few years. Does that inform our view in terms of the time frame then, as to when you can successfully demerge De Beers? That's not a 2026 story? Is that more 2027, 2028? What is your current best?
No, so certainly that does not inform a view of when De Beers could be divested, because of course the process of divestment is pretty broad in terms of the nature and the number of buyers, potential buyers that we've looked at. All of the buyers that we have in the process today are deeply strategic. So these are people that know and understand diamond industries, know and understand the mechanisms of the market, and will see through where we are in the cycle at this particular point in time, given the very high quality nature of this business and its underlying assets.
Duncan, do you think it'll happen this year?
I'm optimistic that it will happen this year, yes.
Okay. What's happening with the coal business? You're restarting a number of mines at the Grosvenor mine. Just walk us through what you think the timeline looks like when it comes to the coal business too. A, in terms of kind of restarts and the progress there, and B, in terms of the kind of positioning this business as well.
So we restarted Moranbah North in November of last year, and in February, just the beginning of this month, we had all the remaining restrictions removed by the authorities. So Moranbah North will now ramp up to its full production capacity, and we are back underground at Grosvenor, with now looking at a possible restart of that mine in 2027 or 2028. As far as the divestment process is concerned, so we restarted the process just after Moranbah North restarted. So this was in December of last year. I'm hoping to get to final bids in Q2 of this year, and still optimistic that we will be able to complete the transaction before the end of this year.
Duncan, great to catch up. Always appreciate your updates. Thank you very much indeed for your time this morning. Duncan Wanblad, the CEO of Anglo American. The stock up by 1.12%, just beginning to climb a little bit more now.
OK, we're going to get more on the economic data coming out of the Eurozone. French PMIs, bit of mixed in terms of what's happening. Manufacturing a little softer, services picking up a bit. We're going to get the views of Catherine Nace telling us what this means for the broader Euro area. We're going to have that interview for you next. Stay with us. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into today's session. Across the benchmark, we're seeing gains of 0.3% after the losses of yesterday. A bit of a turnaround then. The DAX currently up just 0.1%. It's stronger over in France, lifted by the luxury space. Some big gains there for some of those names. LVMH in the mix, of course, up 0.5% then on the CAC 40 over in France. The FTSE 100 up 0.4%. Some of the financial services and asset managers doing quite well as well today. St James's Place is one name in focus here on the FTSE 100. Guy, what are you looking at?
In terms of the breadth, what we're looking at is a 2-to-1 ratio, gainers versus losers. Let's call it 400 up, 200 down. That is the ratio you're looking at in terms of the market's internals. What you are seeing, though, is light volume today, which is interesting. We're going into a weekend when I think there's probably significant risk out there on the geopolitical front to watch out for. So pay attention to that. Single stocks, Montclair is out with very strong numbers this morning, particularly driven by China, which definitely appears not past peak puffer. That stock is up by 10%, nearly 11%. So doing very well this morning. Kingspan Group, the Irish construction company, this is where you see maybe the AI construction story benefiting some of these names in Europe. Its stock is up very nicely as well. Casilium's up by 8.54. So there's some interesting single stock names that we are watching out for. In terms of the downside, let's take a look at what we're seeing here. So Nestle is a little bit softer this morning, but actually where I really want to focus is some of these oil names. BP, Total, Shell, also down today. It's really interesting, actually. If you look at the FTSE 100 and the internals within the FTSE 100, some of the oil stocks are the biggest drags. Some of the defence names are some of the biggest drags as well, which is interesting going into a weekend when you see potentially big geopolitical risk coming out of the Middle East, Tom.
Here's what else you need to know then. And on that topic, a growing contingent of US military forces in the Middle East is escalating tensions in the region once again as the US president ramps up pressure on Iran to strike a nuclear deal. Trump saying that Iran has 10 to 15 days at most to strike a deal over its nuclear program. Blue Owl shares plunged in New York after the alternative investment firm said it will restrict withdrawals from one of its retail-focused private credit funds. The company says the fund will instead return capital through periodic distributions funded by loan repayments, asset sales and other transactions. The move highlights the risks confronting retail investors entering the fast-growing private credit market. And the Financial Times reports Nvidia is close to finalising a $30 billion investment that will replace the long-term $100 billion commitment agreed on last year. The investment is part of a funding round that will value OpenAI at $730 billion US dollars, not including the additional funding. Guy.
OK, let's talk about some of the data we're getting out of Germany right now, which is coming through actually fairly strong. But it's interesting that the manufacturing sector is not now necessarily where the strength is. Germany's services PMI comes through at 53.4. That is up from 52.4 last time round and is well ahead of expectations. German services are doing well right now. The composite number, therefore, is lifted up to 53.1, which again is above expectations. So this is a services story coming out of Germany. What you're not necessarily seeing is as big a pickup when it comes to the manufacturing data. So Germany's manufacturing data comes through at 50.7, which is a good number and is up from the 49.1 and is above the 49.5 that we were anticipating. But it does seem as if where we're seeing the real strength this morning is in the German services story. But the German economy certainly producing a kind of much more positive surprise than one we're seeing out of the French economy, which is really struggling for momentum. Joining us now to discuss all of this, Catherine Nice, Chief Economist, Chief European Economist over at PGIM Fixed Income. Good morning, Catherine. Nice to see you. What do you make out of the contrasting stories we're seeing on the PMI front from France and Germany?
Well, it's not surprising that France is not doing as well as Germany. But let's start with the good news. I mean, I think this is a really good sign that growth in Europe is broadening out. We saw in the last couple of years, it was really the peripheral countries, you know, your Spain, your Italy, your Greece's, really driving growth in the region. And now we're seeing more of a broadening out to the core, including Germany. This is very much what people were expecting. And I think although maybe the numbers are a little bit disappointing on the French side, I think they could have been a lot worse, all things considered. And now with some of the uncertainty around the French fiscal picture really kind of put to bed, at least for the next couple of months, I wouldn't be surprised to see those numbers start to improve as well. So I think this is very good news for the euro area.
How much momentum does Germany have right now? Let's just focus there for a moment. It's taken a lot longer, I think, than some people anticipated to get the economy moving. It appears now to be moving. What's the upside here? How much better could these PMI data get?
So I think, firstly, fiscal, generally speaking, does have an impact with a lag. This is why when economies experience, cyclical weakness, it's really the monetary authority that tends to be the first mover because their tools can just impact economic activity much more quickly than fiscal can. So it's quite normal that fiscal support does take a long time to feed through, especially if it's targeted at things like public infrastructure projects, which require a lot of planning and organization, etc. So I think the time lag that we're seeing in Germany is not at all surprising. Now, in terms of your question about what's the impact, I think we've got to remember the amount of money that the German authorities are throwing at this problem in Germany is vast. And even if it's spent on things that people could argue about, it could be spent better, we could see more reforms, etc. The bottom line is that it's a lot of spending and it is going to have a big impact. You're talking about a delta on German growth that's going from something like 0.1 to 1. So it's pretty big. And I think we are seeing some really good signs of momentum that collectively should give us pretty high conviction that this is going to deliver.
Catherine, good morning. It's Tom. Is that enough momentum to pull the ECB off the sidelines?
What exactly do you mean? I mean, from their perspective, they're in a good place. Growth looks decent.
Do we have to think about rate hikes from the ECB? If not this year, then next.
Honestly, they've got a little bit of a Goldilocks situation going on over there because inflation looks incredibly benign. If anything, I think the risks are probably to the downside. We're seeing the impact of products in China on the euro area. Then, of course, we've had, a bit of euro appreciation, and the momentum within the euro area in terms of domestically generated inflation looks incredibly benign. So I think for now, the risks are, if anything, to the downside. But if this momentum continues, I think that, what we could see is that the ECB makes an adjustment to what it thinks is neutral. So it's not necessarily a hiking cycle in the traditional sense, but it could be that long-term neutral is just a shade higher from where they are now. But I honestly don't think they're quite there yet.
On the ECB, if Christine Lagarde steps down before the end of her term, does that undermine or shore up credibility?
Oh, tough one. So, my sense is that it will shore up credibility because it gives, the other authorities within the EU time to really think about the appropriate sort of set of people that need to be in these leadership positions. I can see the attraction for Lagarde, to step down after all the, peaks and troughs that she's been through at the ECB at a time when growth is pretty much close to potential and inflation is a target. The ECB is much more insulated, more generally, from interference than, say, the Fed. So I don't think that there's going to be as much risk, shall we say, around, maybe the rules of the game changing around monetary policy in the euro area as we might worry about elsewhere.
Okay. Catherine, the reason for this potentially is that people are worried about what happens after 2027 in France, and that we could have a right-wing government that would destabilise the economic outlook. If there are signs of concern, I'm not going to go as far as panic, but there are the signs of concern that has already led to the stepping down early of the French central bank and the potential stepping down of the ECB's chief. Shouldn't the rest of us be worried about what the impact on European growth could be?
I think that this is a risk. We're going to have to see how this plays out. But a lot of the risk is already priced in. We've been having a difficult situation in France really for well over a year. As we get closer to the French election, markets, are going to have a better idea about how to price this risk near term. But, this is not sort of popping up out of the blue. It's something that people have been thinking about for some time. And, there is a bit of time between now and 2027. I think it's quite natural for people to, in leadership positions, to look ahead, to think about, putting in people in positions, in leadership positions when they have the authority and the discretion to do so. This is not particularly unusual. And the sort of set of candidates that people are talking about all strike me as very credible, competent candidates. Turning to France and the risk there, things have gone a little bit quiet. We do have some regional elections coming up that could give us something to think about in terms of going forward. But when I think even about some of the mood music coming out of, for example, when Bardella has spoken previously, I have heard, sort of reading between the lines, that there is going to be a respect for EU fiscal rules, etc. And so maybe this will be less impactful for markets than maybe what people fear.
Just briefly, want to get your take on the UK, Catherine, before we let you go. So the UK, we're seeing gilts gaining again today. Gilts have had a good couple of weeks. So yields down again. The benchmark is at 4.33, the 10-year, the 2-year at 3.56. The UK posting its biggest ever budget surplus. Is there further room to run, do you think, for the gilt rally that we're seeing, further downside for yields?
So I'm going to confess I've been quite dovish on the Bank of England. I do see scope for them to play catch up and to bring rates down decisively over the next couple of months in the run up to the summer. I think people are discounting the potential for sort of a virtuous circle to take hold, that with inflation falling back, it really gives a lot more fiscal breathing space, which in turn just boosts, credibility of the existing fiscal plans. And by April, we could see both the impact of the fiscal measures that Reeves has announced, plus the lower interest rates, really start to inject a bit of a feel-good factor for UK households and firms. So I think people have discounted that possibility. I don't want to look like I've only got rose-tinted glasses on, but I think we are seeing shades of that. I mean, retail sales today were pretty good. And as you say, the revenues are a bit stronger in part, because of these lower interest rates. So I think it's really not all doom and gloom. And actually, the UK economy is doing, reasonably well considering the challenges.
Well, look, we like ending on a positive note on a Friday, so thank you for that. Catherine Nice, Chief European Economist at PGIM Fixed Income. Now, switching focus, shares of the biggest private investment managers on Wall Street tumbling after Blue Owl said it would no longer allow for redemptions from one of its retail-focused private credit funds. It's a complicated story, but we have now Bloomberg senior reporter Silas Brown to walk through what exactly is going. What is happening then in the credit market?
Yeah, so you're right. The shares of the largest private capital managers, that includes Ares, Apollo, Blackstone, and Blue Owl, have tumbled yesterday off the news of this kind of slightly chaotic unwinding of one of Blue Owl's historic BDCs. And I think there's a tainted sort of cocktail of concerns going on in private credit. One of them's around loan valuations and the kind of ability to mark loans effectively. The other is a concern about a kind of broader concentration risk around software and the threat of AI. And I think Blue Owl has kind of seen itself, and is seen by many as the kind of poster child of the success of private credit, and it now is kind of carrying the burden of that responsibility.
I just want to get a little bit more specific in terms of what is happening here. Blue Owl, what is it saying in terms of redemptions?
Yeah, so this is you're right. I mean, it's a very nuanced picture. This was a fund that, unlike most BDCs, was not a kind of perpetual vehicle. Yep. So there was a natural unwinding that was going to occur. They tried to do this through a merger of a public entity. Yep. That was then scrapped, and it was a sort of boisterous response from investors. And so they then have decided to do this kind of alternative thing, which was to sell slivers of the direct lending investments and basically repay investors through those sales. Yep. And they've sold it to 4 institutional investors, one of which, interestingly, is Blue Owl-owned insurance vehicle. And so I think they see this as a quite positive outcome. And by all accounts, some analysts agree. I mean, the loans were sold at close to par. I think that does show a degree of resilience in Blue Owl's credit portfolio.
There was a lot of talk yesterday about effectively redemptions not being allowed in this fund. Is that actually the case, or are they just winding the fund down?
So a normal BDC would get redemptions quarterly, and this is a different route. So that they are not doing quarterly redemptions in the same way as they did do. What they're doing is they're selling assets, and then with the proceeds of those sales, they are distributing that cash to investors. So it's a kind of slightly complicated.
So money's not locked in. The money's going to come back. It's just going to happen at a different cadence.
Different cadence and different method.
Okay.
So, just a BDC. Yeah. A business development company, then.
Accurate.
Yeah. So according to Gemini, a type of closed-end investment fund established by Congress in 1980. Is this less about credit quality, what's sitting on the books, and more about a run on the banks, basically?
So I think This is a very good question, and I think this is the heart of the issue. I think private credit fund managers have for years said one of the great strengths of the market is that we don't have liquidity duration mismatches in the way that other financial markets have. And I think through BDCs and their insatiable appetite for retail cash, I think that this does expose a degree of vulnerability for the market because, the clue's in the name. This is a private, untradable asset class. And so they do have problems with illiquidity. And so I'm not suggesting that necessarily this is an issue in this specific instance of Blue Owl, although they have had investor withdrawals in another bigger fund as well that are substantial. But I think what it does is show there's a kind of glint here that I think is concerning investors in the public markets, I think, which illustrates some of the tumbling, the consequences, behind the tumble.
You bring some clarity to the complexity, Silas. Thank you very much indeed. Really valuable insights. Bloomberg's Silas Brown covering that story for us. Coming up, billionaire Steve Cohen has taken the top spot. So from private credit to hedge funds on Bloomberg's annual list of the world's best paid hedge fund managers for the first time. How much was Cohen's total earning from his hedge fund? 0.72, of course, last year, just in a single year. The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked you how much did billionaire Steve Cohen make from his hedge fund, 0.72, last year, in a single year? The answer, drum roll, 3.4. Let's bring up the number, 3.4 billion US, 3.4 billion US dollars. That works out, by the way, to more than $9 million a day. Not bad for a day's work. Cohen has taken the top spot on Bloomberg's annual list of the world's best paid hedge fund managers for the first time. In less than a decade, Point72 has added 12 offices, more than doubled its global staff to 3,000 and expanded the number of its trading pods to more than 190. Guy.
Quite like sport as well, which is interesting. OK, let's talk about what is happening out there right now and what we are watching. Oil touching its highest level in 6 months. This after President Trump said Iran has circa 15 days to reach a deal over its nuclear program. Ziad Dawood, chief emerging markets economist for Bloomberg Economics, joins us now from Dubai to talk about this. Ziad, how do you see this playing out? The oil market has added a little bit of premium. What kind of risk are we looking at here that prices go significantly higher from here in terms of how the market needs to price this risk?
Well, I think if you look at the geopolitical situation, Guy, there's on the US side, we're seeing the biggest mobilization of US military assets in the region since 2003. We're seeing a deadline, a 10 to 15-day deadline from President Trump to Iran. And on the Iranian side, we've seen threats from the Iranian leadership that the conflict could spread to the wider region. And we're seeing basically fire drills from the Revolutionary Guards that are resulted in the temporary closure of the Strait of Hormuz. That's big risk to oil. The degree of risk depends on how wide the conflict spreads. If it remains confined to Iran, we're talking about 5% of global supplies. If it affects the Strait of Hormuz, we're talking about 20% of global oil supplies. If we're talking about the wider region beyond Iran, that includes Saudi Arabia and Iraq and Kuwait and the wider Gulf, we're talking about 1/3 of global oil supplies. That's a lot of oil at risk that is very hard to replace. And that's why we're seeing war risk premium in oil, which we estimate today is about $5 per barrel.
Wow, yeah. So from 5% to 20% to maybe 1/3. I mean, that's a big range and a lot of variations. What is being priced in right now?
So we track the daily geopolitical risk premium in oil prices. We have that available in the terminal. And currently, we estimate about $5 per barrel are due to the Iran war risk premium. To understand that in the wider context, it's important to just figure out, have three levels of oil that are important. There was a $60 oil per barrel that we had before the escalation with Iran. There is a $72 oil per barrel that we estimate where oil will head to if you get complete outage in Iran. And there is $108 per barrel where oil will head to, according to our estimates, if you get the closure of the Strait of Hormuz. The fact that prices have moved by $5, that tells us there is the markets are pricing a probability that you're going to get some outage, probably from the Middle East.
Okay. Zayed Daoud, really important update for us of Bloomberg Economics. Currently, Brent trading a little softer in the session, down 0.3, but holding above $71 a barrel. WTI at 66. That divergence is still there. WTI down 0.2%. Here's what else to think about through the day then. 9 a.m. UK time. So in the next couple of minutes, we're going to get Euro area followed by UK PMIs. That's at 9:30. The US PCE data and GDP data due at 1:30 p.m. UK time as well. Plus, we're going to get US PMIs at 2:45 p.m. 3 p.m. UK time, we're going to be watching the Supreme Court as they mull the future of Trump's tariff campaign, and more Fed speak from Laurie Logan as well.
After you get through all of that,
yes,
there are interesting things happening elsewhere. It is almost the weekend. You've got the curling this weekend, curling tonight.
Yes.
Gold.
So Great Britain versus Canada.
Yeah, beat the Swiss.
Beat the Swiss, very close.
Yep.
What was it, 6-5?
No, I think it was a bit more than that, actually. But yeah, it was a surprise that we were so convincing.
Beat the Swiss.
That we were so convincing.
So the Canadians have been embroiled in Touchgate.
Yep, we'll call it that.
Nudging, touching.
Not going to go down this road too far.
The what's it called again?
The I don't know, the rock.
The rock.
No, it's not the rock. It's the stones.
The stone.
My mind went blank then. London Fashion Week this weekend, which I know you'll be paying a great deal of attention to.
Absolutely.
You got the BAFTAs, which actually I think you probably will be paying attention to.
I'm interested in the BAFTAs. Generally interested in the BAFTAs. You though.
Six Nations coming up.
Six Nations. I mean, Scotland, England. That was a bad setup.
That's a wake-up call. The Scots after losing to the Italians, the Scots were all over it. The England need to come back and beat the Irish. We'll see. The T20, I think, is kicking off this weekend as well. I think you've got the ice hockey final. I think that's Sunday.
Oh, that will be fun.
Massive weekend of sport.
Elbows up.
Oh, yeah. It's been some great ice hockey. Actually, the game, I was watching the women's game last night. Fantastic game. Anyway, let's talk of the weekend. We've got some great Bloomberg weekend newsletters coming out as well. Just pay attention to that as well as you watch the sport. You can do two things at once. Have a great weekend, folks. This is Bloomberg.